Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his
Here's the Sandman.
over Sandman.
Happy 2026. I am David Hollander, your host, and I'll be your drill sergeant this entire month as we roll out our New Year's resolution boot camp.
Hooah!
It's so great to be with you this morning. We have a great show planned for you today. For those of you just joining us for the first time, welcome. People around here, they call me the Sandman. That's because I help figure out your most difficult tax, legal, financial questions. We've been doing this for over 30 years. You can also email me a question anytime you like by sending it to questions@PYARadio. That stands for Protect Your Assets. PYARadio.com. Again, questions@PYARadio.com. We are living in an interesting time, aren't we? So many things just happened since we started this year. All these things are happening. We're going to talk about that here in the market segment. But we've been doing this boot camp for almost 20 years, and we've designated the month of January each year to help you keep your New Year's resolutions. If you missed last week's show, it was our financial savings class 101. We talked about basics when it comes to saving more money in 2026. Some ideas and tips that you should be taking advantage of this fresh new year. This week, it's our advanced class where we will unveil some of our top ideas for 26 for supercharging your savings and generating more income now or in the future if you're thinking about retiring this year. Tax laws have changed, and now there are really some great tax tips that you could be taking advantage of this year. Are you prepared to retire right now? Well, stay tuned as I help you decode and decipher these new tax laws. Say if you're at or near retirement, then this episode is one that you don't want to miss out on as I take you through a 45-minute advanced retirement boot camp training class. It's a brand new year. Take a big gulp of that ritual coffee, get something to write with, and get your notepad open. It's going to be a great show, so keep it right here. Now, let's get started. So the first full week of 26 was eventful for markets with Venezuela, talks of Greenland. The December labor market report came out and the Supreme Court decision. We're still waiting to hear what happens with that on tariffs. Markets overall like this week. Dow was up 2.3%, S&P up 1.6%, NASDAQ up 1.9%. International index continues to move forward, almost 1% for the week. 10-year Treasury held flat at 4.17. Oil, well, oil's still under 60 at 58.82. What does Venezuela mean about oil? We're going to talk about it here in a second. And the bond market was up slightly at 0.3%. So overall, while these events certainly created headlines, it was a busy week. In our view, the outcomes could be limited when you talk about the economy or markets in the near term. So Venezuela, what are the implications from a market perspective? Well, Venezuela is a relatively small player. Its economy is less than 1% of global GDP, and it represents less than 1% of U.S. and global trade. The country does have about 17% of global oil reserves, but due to failing infrastructure, they deliver just about 1% of global production. So the broader implication to monitor as we move forward with what's going on is the precedent that this action could set globally, especially given that the U.S. plans to retain power in Venezuela until a transition of the government occurs. It's still early days, but this could be a longer tail risk to watch, particularly given economies like China and Russia contemplating their own steps. In addition, there may be implications to oil prices in the U.S. and energy companies because they're looking to rebuild Venezuelan oil infrastructure. While this could help the Venezuelan oil industry, make things more positive down there. It takes time. It takes investment. And we're looking at possibly 10 years and upwards of $100 billion to turn that situation around. Keep in mind, oil prices are currently near a multi-year low, sitting at under $60 a barrel at $58.82. And oil markets globally continue to face oversupply issues. That's what's keeping the price down. So this shift that's going on to electric vehicles also doesn't happen. Make it helpful. And, in China, they're doing a lot of that. A lot of new manufacturers coming on making cars, challenging Tesla's dominance. So over time, if additional Venezuelan oil supply creates more downward price pressure, oil companies could face operating at below break-even rates. And that's not favorable for shareholders, obviously. So in the near term, while oil prices could move marginally higher, given the political potential disruptions going on, obviously, across the world, the longer-term picture, well, I just don't think more supply is really going to help prices that much. Probably do the reverse. So just keep that in mind. What about the U.S. jobs? So we just had that. We had the December figure came out. Again, this was the first true, clear picture we had since the shutdown. And that wasn't looking so great. It came in at 50,000 below estimates of 70,000. So while we're seeing a slowdown in job growth in the U.S., the unemployment rate, well, it came in pretty steady at 4.4. And this information believes that the overall economy is still pretty good, doing pretty well. So the Fed likes that sort of information, and they're going to be cautious because it does look like the U.S. jobs market is cooling down a little. And this week on the 13th, we're going to get the inflation data coming out. And then the other one that we're waiting for right now is the Supreme Court decision as to whether the president had the authority to impose the tariffs as expansively as was done under the IEEPA, International Emergency Economic Powers Act. So overall, while it's been an eventful first full week of 26 from a geopolitical, economic, and policy perspective, I think the good news is that markets are focused on key drivers. U.S. earnings growth, it's been revised higher to about 14.7% year over year. And if we get lower inflation, like economic growth continues to deliver, according to the Atlanta Fed GDP Now model, they're saying 5.1%. It's above the trend of 2%. And so the S&P 500, as I just said, it's up about 1.9% so far this year. Don't forget, you want to speak with your financial advisor who can help you navigate economic, geopolitical, and policy shifts and help ensure your portfolio remains on track to achieve your personal financial goals, particularly if you're looking at retiring this year. So keep it tuned right here, because when I come back, think you need to take your RMD? Well, maybe not. Find out how. You want to keep it tuned right here. You're listening to The Sandman on the Protect Your Assets show. We'll be right back.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the waitlist today. pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman around here, and you're listening to Protect Your Assets. People call me the Sandman. I got that this week. Why are you the Sandman? Well, they call me that because I help by letting you know about the most recent tax strategies and legal protections. That's what we do. This entire month, we're doing a boot camp. Hoo-ah! Each week to help you keep your New Year's resolutions as it pertains to your money. This week is our advanced class where we're talking about taxes. Tax laws have changed. So how will those changes affect your 401k, your IRA, your Roth, your retirement, your pension? So much to talk about. Let's start out with some current ways to get more income right now. So again, this is the first week of January 10th. I'm looking at an income strategy right now that could allow somebody who is 66 to start taking, again, this is as of yesterday, 7.05% immediately from their savings account in terms of a cash flow. And that will last for their entire life. Even if you spent through all the principal, and this is backed by the claims paying ability of the issuing company, insurance company who does that. They're A-rated. And I like this option right now because it gives you a nice withdrawal rate that's protected from market fluctuations. And if you think you're going to live a long time or you're not sure, this protects against the uncertainty of running out of money in the future. Moreover, any interest you earn, if you don't take the income, that'll be tax deferred, almost like a second 401k if you're saving. There's no limits on this in terms of what you can put away. And right now, the same company is offering an 8% roll-up on the income option. So that's available now. Before the break, we were talking about the RMD. What does RMD stand for? Required minimum distribution. It means that you're required to begin taking distributions from your IRA account in the calendar year, depending on when you were born, right now of 73. Now, depending on when you were born, it could be as high as 75. And that will increase to that number in 2033. First of all, understand that when you pass away, if you're married, your spouse could continue to take the RMD based on their life expectancy. But if your beneficiary is a non-spouse, like your kids, then the rule now is that that child must exhaust that balance over the next 10 years. Now, there's an exception to this. What if because I see this a lot, your attorneys name your trust as the beneficiary of your retirement accounts. You pass away, and then there's this thing called the ghost rule. You could look this up. I'm not making this up. The ghost rule requires a 5-year distribution. So a 5-year distribution. And if there's no beneficiary named or the beneficiary is no longer around, I saw this just yesterday. I was looking through some documents and I saw the spouses had named each other as the executor. And who's next? It was blank. You're kidding. Your attorney signed off on this, was notarized. It's blank? What? Okay. Anyway, that's called the ghost rule. And that requires a 5-year distribution as opposed to 10. That's not good. So anyway, I'm talking to another person this past week. They were 71 and they were still working. Now, this person is the CEO of a corporation. He's contributing to his 401k. He's 71 and he was aware of this RMD rule. And he thought, well, I was told I have to start taking the RMD. Why is that? Well, because I was able to roll over part of my 401k from the 401k to an IRA and self-direct it and pick some of my own funds. And I said, oof. Shouldn't have done that. Why? Because of the situation you're in right now, the IRA in your age bracket requires an RMD. What? I mean, you need to take money out of that account this year because of your age and because you moved it from a 401k to an IRA. If you left it in the 401k, you wouldn't have to take the RMD, even if you're age 73 or older. I just saw him start scratching his head, didn't really, looked at me with that look, right? Like, I'm not sure what you're talking about. And I said, well, do you want to pay tax on that money or not? No, I don't want to. I don't need it. Well, now you have to because you can't go backwards. It's the problem. So be careful when you do these rollovers because you don't necessarily have to do what you think you might have to do. And just remember the rule. If you're still working, even if you're RMD age or older, and you have a 401k, or a 403B, or you're in law enforcement, maybe with 457, you don't want to necessarily change that. I know it's compelling and it sounds like a good idea in a lot of cases, and it might be, but just look at some of the other options that are out there, particularly if you're sensitive to this sort of an issue. So in this person's case, it would have made more sense to leave it in that 401k and just keep contributing. And, you know, he's going to retire in a couple of years here, and that'll be that. Obviously, tax planning, it's not simple. In fact, it's confusing, and the deeper you start to scratch this, the more you get into trouble. And right now, with the 32% joint filing tax bracket being over $500,000, there may be a lot of room there for you to move some things around and get yourself back into the federal 24% bracket. And this is the time to do it, right now. So it makes a lot of sense to meet with our team, or a team who looks at tax investment decisions each and every day. In our office, if you choose to use one, we do have tax advisors. We can work in conjunction with yours as well. There are state attorneys. There's financial advisors. We work as a team to walk you through these types of decisions. Now, we can help you achieve your goals by keeping more of those tax dollars at work instead of taking them out. If you want to find out more about this right now, then here's what you can do. You can pick up the phone, and we're happy to walk you through some of these strategies that we're doing right now by getting our checklist. Now, this checklist will be emailed to you right now to get your 2026 tax strategies checklist. Call this number, 866-PROTECT. Coming up next on Protect Your Assets, it is time for our popular They Say segment, where they say Roth always makes sense. Is that true all the time? We'll find out the answer. There's so much more to come. Keep it tuned right here. You're listening to Protect Your Assets with David Hollander. That's me. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. Was one of your New Year's resolutions to make some big changes to your financial life in 2026? Well, if the answer is yes, then you're going to want to listen to the entire show today as I've pulled together our top ideas for 2026 when it helps to keeping more of what you work for. Last week we did our Basic Financial Planning 101, and if you missed that, then go and listen to our podcast. Wherever you get your podcast, just type in Protect Your Assets, and you can type in the name of the show or the date, and you'll find what we were talking about. It'll be right there. Or if there's a subject maybe you want to know about, you just put in the Protect Your Assets and what you're looking to find out more about, and podcast should be right there for you to listen to. This week, you've jumped into the advanced class, if you're just tuning in right now, where we are getting hyper-focused on what's working in 26 from a tax perspective. And that reminds me, we have started up again, our Tax Smart Retirement Workshop. Now, this is where we have you come out. You have a great dinner with us. This past week, we had a great turnout at Perry's there in Larkspur. And we talked about some really interesting cases some people brought up in the audience. And it was I enjoy it. I like that on the moment. So if you want to come out and see what we're all about and ask some questions and find out what you can do to get your tax life structured as it pertains to your investments or your estate, maybe you need to talk about a will or a trust or something like that, we're happy to do that. And a couple of ways to register. One is you can call 866-PROTECT right now and get on our seminar list. The other way is you can go to our website, libertygroupllc.com, libertygroupllc.com. Click on the events tab at the top. When you do that, it's going to take you to a page where we've got all the events coming up. We'll be at Perry's again this week on Wednesday. And then the following week we'll be at A16 in Oakland. And then out in Walnut Creek, that's going to be the workshop there will be on the 28th at Massimo Restaurant. So if you want to register for any of those, you can just click the little blue register button. You want to bring a friend? That's okay too. Just click it and register and you're in. It's that simple. So if one of your New Year's resolutions was to make some big changes to your financial life in a positive way, well, let's talk about our They Say segment. Now it's time for our fan favorite part of the show. This is our They Say segment where we debunk common myths, half-truths, sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All right, so I heard this week. They say that you now have to take your RMD at age 72. Is that always true? No. If you were paying attention to the last segment, we sort of clarified this, but no, it's not true. As I was saying in the last segment, 73 is the answer now. But what about when it comes to a Roth? Well, are they always a good idea? Well, it depends. We're going to talk about the difference between Roths. There's something called a contributory Roth and a Roth conversion. First, make sure you understand the difference between the two. When it comes to a contributory Roth, if you're a single filer and you make less than $153,000 and you're under the age of 50, then this year you can put away $7,500 into that contributory Roth. If you're over 50, you get a catch-up provision. You can put away $8,600. Now, if you're married filing jointly and you make less than $242,000 and you're under the age of 50, again, you can put away $7,500. And if you're over 50, you can do $8,600. Backdoor Roth IRA contribution strategy. Again, we're talking about contributions. So this would be where you make a non-deductible. So let's say you're going along, you're making your 401k contributions and all that, and you're making more this year as a single person than $153,000. You could contribute the $7,500 into a non-deductible IRA, and then the next day you move that over into your Roth. And because it was non-deductible, you're not claiming that deduction. So therefore, you can make that contribution to the Roth. This is called the backdoor contribution strategy. Well, what about a Roth conversion? Let's say you're not looking to do RMDs later in life. They just don't make sense because you have other income. Who should consider this Roth conversion idea where you convert money from an IRA or 401k to a Roth? Let's talk about this. Let's say you believe your tax bracket's going to be higher in retirement. Well, that could happen because they decide to raise tax rates, right, in the future. In this scenario, paying taxes at the current tax rate, which remember, again, if you're in the 12% bracket, married filing jointly, making $96,950, or let's say you did a conversion and now your income's up to $200,000. You're still in the 22% bracket. Is it possible that if you had that kind of income 15 years from now, those brackets could be higher? If you believe that you'll pay higher taxes later in retirement, then you might want to think about this conversion strategy. Let's say you want to maximize your estate for your heirs. If you don't need to tap your IRA funds during your lifetime, converting from a traditional IRA to a Roth, well, this allows savings to grow tax-free. There's no RMD required. And this could leave more money for your heirs who can withdraw that money tax-free as long as they follow the IRS distribution rules. How about your accounts aren't diversified by tax treatment? What does that mean? Well, that is most of your assets are in 401ks. By converting to a Roth IRA, you'll have assets that won't be taxed when you decide to take them out during your lifetime. This could allow you to better manage your tax brackets and enable more personalized tax planning during retirement. Let's say you have irregular income streams and lower than usual income here in 2026. Well, you might own a business that generated a net operating loss from non-passive income this year. This could be the perfect opportunity to convert some funds to a Roth IRA with a relatively low tax impact. Well, what about the other side of this coin? Who should not consider converting to a Roth IRA? Well, let's say you're nearing or in retirement and you need your IRA money to live on to cover your living expenses. That's probably not a good idea, because part of the idea with the conversion is you give it enough time to grow over time. If you had a great year, maybe horsepower and charge it up there a little bit tax-free. You're currently receiving Social Security or Medicare. If a Roth conversion were to increase your taxable income, then more of your Social Security benefits could be taxed, and the same goes for your Medicare costs. Those could rise. So you want to look at that. You don't have money to pay the conversion tax, or you must sell assets that could lead to an additional tax hit if you did this. So using IRA funds to pay for the conversion tax could negate the benefit of converting. A better option might be paying the tax with cash you had, say, sitting in a savings account earning no interest. If you have to sell assets in a taxable account to cover your conversion tax, it's best to focus on those with the lowest gains, maybe some bond funds or bonds you own as opposed to some of the stocks that really appreciated. You plan on giving a substantial amount of your IRA to charities, and you might use that QCD strategy. Some retirees use QCDs to satisfy their RMD. This doesn't create any taxable income, lets you keep more of your Social Security or Medicare taxes under control. In this person's case, converting to a Roth IRA, well, it might not be as helpful as you otherwise thought because you're not being taxed on the distribution. As you can see, there's a lot to consider when you think about conversions to Roths. And if you are not thinking about this or talking about this before you do the conversion, well, that could be a problem. And yes, tax planning is complicated. And of course, we recommend that you bring in a tax professional to help as part of this overall decision. Hopefully, you're working with someone who's helping you do that. But if you're not, then that's why it makes sense to meet with our team who looks at these sorts of decisions every day. We can pull in the tax person. If you decide to work with that person, we can pull in the financial advisor, the attorney, and we can talk about these kind of things. If you're tired of the same old routine, meaning you have lots of questions that keep getting unanswered, maybe you're not looking at different angles of what could possibly happen, pick up the phone right now. Give us a call. We're going to send you our checklist. This is brand new for 26. It's got some great ideas in it. Take you a couple minutes just to read through it. We'll email it to you right now. Call us 866-PROTECT, 866-PROTECT to get your checklist. John D. Rockefeller said the surest way to accumulate wealth is to not pay tax on income you're not using. Are you going to take advantage of some of the new loopholes that are out there? Well, if you're not sure what those are, how you use the tax code to help you accumulate more, then stick around for this last segment. We'll be right back.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the wait list today. pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. We've created this episode of Protect Your Assets especially for you. Because at the Liberty Group, we help our clients by integrating their investment and tax planning. That's because investment planning that incorporates tax efficiency, well, that could be a pretty good plan. Listen, with the massive tax law changes that just happened, the best thing you can do right now is to plan smart. That's what we do with our clients proactively. Think of it this way. When was the last time your financial advisor took a look at your tax return? So you're listening to the show today so you can understand how tax reform will impact your bank account, so you can take advantage of the 500 plus pages of this new tax code. And if you're not looking at that, if your person's not aware of your situation's not helping you think through this, then think about that. Maybe you need to make some changes. Maybe you need to look at some other information. It's not just one-dimensional. It has a lot more to do with the future. Did you see that Forbes article? California capital gain tax is 14.4%. There have been several proposals in Sacramento to increase that rate to 16.8%, but it's 14.4% on capital gains were for those people who earn over $1 million in that particular year. At the federal level, the capital gain rate there is 20%. Add the 3.8% net investment tax, and you have 23.8% federal. Add 14.4% California. Now you're looking at almost 40% capital gain tax on your long-term capital gain. That's higher than anyone else in the world. Think about that. Are you going to move? Probably not, but moves before big stock sales, sales of a company, well, they're not uncommon anymore. And so if you're thinking about things like that, or you're trying to gift more money, as somebody asked me about the 529s that pertain to grandkids, yes, there are ways to do this. There are ways to transfer more. But if you're unaware of them, you don't know how to do it, well, then give us a call because we're here to help you. We can walk through these scenarios using our e-money planning tool, where we can show you some of the things that can happen if you do certain things. So remember, in our office, if you so choose, you can work with the CPA. You can work with an estate planning attorney. You can actually work with a financial advisor. I'd like to give a big thanks to the whole team for putting together a great show today. My executive producer, network manager, Kevin Renfer. And of course, all my fabulous producers working today. You got Phil, you got Raph, you got Nick and Zach. Thanks, guys. Because without my team, I'm just another pretty voice on the radio. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You are listening to the Protect Your Assets Radio Network.